Yes, space really didn't permit me going too far in depth about how to trade stochastic or exogenous, or you can use any sort of number of synonyms for events that hit out of the blue and have, let's call them low probability, high impact. And the recent events in the Middle East would certainly qualify under that scenario. Um, I strongly urge you to refer to the original article, which we've linked below. But one of the things I really didn't get into there is probably the most important facet of how the market reacts to news of of an exogenous nature, of a stochastic nature, um, is has to do with how the market's behaving overall. And it seems so painfully obvious, which is probably why I didn't really put it in the article. But the more I think about it, the more important it is. Um, Bottom line, if some sort of market moving news hits during a bull market, markets tend to digest it better than if it hits during a bear market. Plain and simple. Um, in a bullish market, um, the buy the dip mentality is very much in place. The buy the dip strategy tends to work. And so you have people willing to step in at some point, either when the dust settles or even beforehand, willing to take a shot and either cover shorts or use that as an opportunity to go long. Because if you've been riding a short in an up tape, you really kind of need these dips to cover yourself. Or it's an opportunity to buy and proceed on ahead because buying the dip tends to work. And in the case of the recent geopolitical events that we saw, it tended to work again. Now, a lot of that has to do with the fact that there was, at least the time we're taping this, a positive outcome. There was the initial event, which was shocking. There was the response, which was relatively measured. And as of now, there really appears to be no response to the Iranian response. And I think we could put the issue at least to bed in the short term. Um, Bearing in mind that someone described this to me yesterday as the Middle East is the epicenter of all geopolitical events, really, when you get down to it. So the risks there never fully go out of the way, but I'm talking in terms of the short term. Um, Compare and contrast that to some of the events that we would see when the markets have been in a very negative frame of mind. I think back, to what many of us consider the ultimate geopolitical event, if you're of a certain age and a certain geography, and that was 9/11. And in the aftermath of that, there were numerous stories and scares about um, various incidents or rumors of terrorism, and there were actually anthrax attacks that happened afterwards. And then any report of white powder would send particular stock or the market into a frenzy. People were very shaken up by that, and as a result, those pieces of news were far less clear as a buying opportunity because people were freaking out, and that was a bearish scenario, and people did not want to hear about anything negative when they were already in a negative and scared frame of mind. Similar similar thought process took place, let's say, in the 2007-2009 period, which was a nasty bear market for those of you who were involved at that point. And more or less any negative story, whether it was global or on the banking situation, would send the market into a bit of a tailspin. What we're seeing now is a generally and genuinely sanguine marketplace where the buy the dip strategy more or less has worked for a number of years, and winning strategies die hard. So that's really something to keep in mind as you're starting to think about the impact of events. If you're in a bullish market, there'll tend to be a situation where people step in and buy until or unless that situation is so great, or until or unless the market psychology changes. That's how you would help to trade accordingly.